Hello, credit union executives. Welcome to See You on the Show, where we give you up-to-date information on how you can reduce risk, keep key talent, and take a strategic approach to your personal financial wellness. Hosted by me, Doug English, a certified financial planner and former credit union insider with ACT Advisors. My guests on today's podcast are Bill Patton and Greg Hill from Alloya Corporate Federal Credit Union. Bill is the Vice President of Loan Participations, Lending, and Subordinated Debt, where he is responsible for the overall performance of Alloya's corporate loan portfolio. Greg is a Strategic Initiatives Consultant, where he has worked on several key initiatives, including architecting, managing Alloya's loan participation program. He's a former credit union CEO and was also previously an Alloya board member. In this episode, we talk about capital markets for credit unions, including subordinated debt and what you can expect of the subordinated debt process as an issuer. Bill and Greg, thank you for joining me today. I know from our conversations in advance of this interview that Alloya is doing work in what I'll call forward-looking areas. Can you tell me a little bit about some of that work?
I can lead into that, and I think I can paint a picture historically what we had been and kind of what we're trying to do. And so looking back, corporates really have been from a capital markets perspective, what they've done is they've helped credit unions invest their funds through fixed income securities, CDs, that kind of stuff. And they've provided short-term and in some cases a little bit longer-term loans through the corporates, similar to like what the FHLB system would do, right? And that's primarily all they've done as it relates to capital markets. So they've done those two things, and they've done them very, very well. But as credit unions have grown and they become more complex services are required for credit unions to meet those changing balance sheet needs, right? And so one of the things Alloya has done, whether purposely or just by chance, and I'll have to take a look back in 2 or 3 years and try to figure out whether or not we did it purposely or not. But one of the things that we've done is we've really kind of gone in on the capital market space, understanding that this is what credit unions are going to need. And so the first step in that direction was 7 years ago, we started helping credit unions trade loan participations just through our inbox, right? Credit union would come to us. We had at the time what was called Part 5 authority, which allowed corporates to purchase loan participations from credit unions. And that was rescinded from us. And so we still had credit unions who would historically sell to us and we would buy and hold it on our balance sheet. They still needed to get rid of those loans, right? And so what they did is they called us and said, hey, can you help us move these loans just like a broker would? And so for about 4 years, that's what we did. We just helped them. My supervisor, Tim Bruckier at the time, who kind of let me take this opportunity and run with it, which he didn't need to. I think in 4 years, we did like $1.5 or $2 billion worth of trades that nobody had even known about. We were just kind of doing this on the side, and it kind of just became this big thing. And then our CEO, Todd Adams, said, hey, this is what credit unions need. And he challenged us, this is when Greg was brought in, to create a platform for loan participations, because the trading of loan participations at the time was very clunky, it was arduous, it's a lot of headache. And so what we wanted to do is we challenged ourselves to take all of the headache out of loan participations, at least as much as we can. My tagline is, we're the Tylenol of loan participations. We take away the headache of participations. And so that's what we've done. That program, Greg built that with a couple other people, specifically Ryan McCarroll, who's a vice president of loan participations now. And I think in 18 months, we've done about $1 billion in trades, especially in a market where not a whole lot of trading activity was being done. What that platform does is it allows the efficient trading of these loans, the reporting, the due diligence, and it allows credit unions to buy smaller pieces of these pools and of these loans. And historically, they would not sell. So historically, a $10 million deal would go from one credit union to another, or maybe 1 to 2 other credit unions. Through our platform, you can go to 1 to 20, 1 to 30 credit unions. Doesn't matter. They're the only counterparty, I should say, is Alloya to both parties. So it's really great. And that's a really high level overview. So that was kind of our first foray into that. capital markets outside of what we historically done. We've brought on sub debt, and Greg and I are really tasked with going out and finding new things for Alloya to get into. And we're working on a variety of different things. Whether any of those see the light of day, we'll find out. But we are, we've really tasked ourselves, and Alloya has tasked us with going out and finding things that credit unions need to be really there and at the forefront of credit union capital markets. So I talked a whole bunch. Greg, what did I miss?
I don't think you missed a lot there. That loan participation platform is the one thing I'll say about that, just as a little bit of a pitch. It's fully automated. So it really does eliminate all of the headaches that credit unions have on the issuer or the seller side and on the buyer side. Sellers don't have to do all of the monthly work that they're doing now with all of these direct participations that they're doing. They literally can upload a single data file regardless of the number of pools they have, and that's it. They can wash their hands of it. Alloya takes care of all the reporting, all the funds transfer, everything else. And even on the sales side, it's a very simple process. It's a single file upload to make it really simple. The buyers love it. We provide full reporting for them, including a call report, which they absolutely love. That provides everything they need for themselves, regardless of the number of pools they purchase, regardless of the size or the number of originators. So it fully automates every aspect of their lives, including a standard participation agreement, which was a really big deal to get completed. We worked with, I don't know how many credit unions to talk to get to a final agreement on that. But we now have, I think, over 300 or 400 credit unions signed up with the platform, 30 or so plus sellers, 100 or so plus buyers. Like Bill said, over $1 billion now of transactions since we went live with it.
You guys are making a difference in the credit union movement. Another solution you provided credit unions deals with subordinated debt. I know you've partnered with one of our past guests, Jeff Cardone of Lewis Gorman, to offer a full-service solution to credit unions looking to either invest or issue sub-debt. Now, I know, of course, issuing credit unions have competition with other investments, mortgage-backed securities, other things. So how do you get investors interested in taking on sub-debt?
So if you have a comparable investment that's, let's say it's an MBS or something of that nature, that's a comparable weighted average life, an issuing credit union is going to have to compete with that, right? And so they'll have to go above that level to get investors intrigued. So there's different things that issuers can do. They can structure the security a little bit differently. We're seeing fixed to floating type structures, which is interesting, right? So rather than just a straight fixed rate for the 10-year term, it's fixed for the first 5 years, floating for the last 5. And so we think that might be enticing to credit union investors. We're also talking to investors outside of the industry a little bit who are keenly interested in this. They had been purchasing bank subordinated debt hand over fist over the last 5 or 6 years. And they've engaged with Alloya and I'm sure other entities to start potentially buying that. So there is interest. And I think as these become more commonplace, credit unions specifically will be interested in investing in these. Because again, at its core, it's a loan to another credit union. There's a lot of reasons to like that investment. There's political reasons, there's philosophical reasons, but monetarily, it's also just going to provide a greater yield compared to comparable investments. So I hope that answered your question.
It did. So let's talk about the ability to change from one to the other. You've got to choose, right? You can either be an issuer or you can be an investor. Yep. So what's the market for the ability to go from one to the other?
Yeah, I can take that a little bit. We think that's been one of the key issues for potential investor credit unions, why they've been a little bit hesitant as well, because they've seen what's happened in the last couple of years with balance sheets exploding and net worth ratios dropping. And so even some of those credit unions that have relatively high net worth ratios that are not considering issuing now, they just have no need for it now. We feel like some of them are just looking to keep their powder dry because they don't know what's going to happen in 2 or 3 years or 4 or 5 years. So if they invested today, they would not be able to issue in the future unless they were able to sell that investment. And that's one of the things that we're trying to do at Alloya and with our Alloya Solutions LLC partnership to actually build a secondary market potentially over time with these credit union issuances. And so that other potential credit unions, if they do invest and at some point do need to issue down the road, there would be a market for somebody else to purchase that off their hands. Now, obviously, that'll come with a price, right? Depending on where interest rates are at, depending on where the issuing credit unions financials are at that point in time to determine how much risk someone's willing to take on. But we think that's one of the things holding back a few credit unions from potentially investing is just they want to have that ability to wait and see if they need to issue. And so we believe if we can create a little bit more of a secondary market, or at least know that there are credit unions that are looking for this investment on the secondary market, that we'll be able to get a few more credit unions up and going, because that's actually been one of the struggles we've seen is just credit unions are holding off a little bit. Like Bill said, they're a little nervous to get started investing in this. Although if you go look at some of the data, I think there are over 100 credit unions right now in the country that actually have investments in secondary capital and some in the new subordinated debt. A lot of them are older investments that were made in secondary capital, but that still counts from the regulation. So those credit unions would not be able to issue. So there's going to be more that'll consider this that just won't have a need to potentially issue. And we'll start to get into the investment side of things. But we do believe that NCUA did want to bring in funds from outside of the industry with some of these. And we certainly saw that with one of the larger issuances that just came out. And I won't mention the name, but credit union just issued a couple $100 million subordinated debt. It was the first one in the marketplace that happened. And that one did get a fair number of credit unions, but there were also many other investors that came into that from some insurance companies, some banks and others, and other asset managers that came in with the investment. We are going to see investment from a lot of different places. And it's really just at this point, getting the word out to those other investors that this is out there and that it looks like a good investment.
Is there no capital markets option for credit unions at this time? Is Alloya the innovator in that space?
We're trying to be. But right now, there isn't any other type of capital markets group that's working specifically to create a secondary market for this. We've spoken with several other of the potential issuers and broker dealers that are in the space helping credit unions. And I think you'll start to see a little bit of cooperation there within this group of potential investment banks and others to try to make sure that we can provide a secondary market for this. You'll start to see a little bit more of these deals on the credit union side. We anticipated that most of them would not get rated. They're going to be smaller deals. They would be unrated, like some of the smaller bank deals. But some of these larger ones have been getting ratings. You'll see QSIPs for all of these deals so that at least if somebody does need to, there will be the potential for a secondary market for this. And that's something that we would like to help build over time with our credit union partners.
Yeah. Well, I like what Bill said about the 5-year fixed rate and then 5-year floating rate. That way, if you're in an interest rate environment that's going up, as we all appear to be, that would take at least some of the interest rate risk off the table.
Yeah, that's interestingly enough, that was banks have pretty much primarily been issuing with that structure, 10-year terms, 5-year no calls with fixed to float rates, fixed for the 5 and floating in the last 5. Whereas the credit unions that we've seen have almost exclusively issued fixed rate notes, 10-year fixed rates, which is pretty typical from credit unions' perspective. They don't want that additional interest rate risk from the issuer side. But as rates move a little bit, investors get a little bit nervous with those types of structures. And so we are actually the first deal that we're going to be placing out very shortly. And we'll have a fixed to floating rate structure, which we think will be the first one from a credit union's perspective on the new subordinated debt rule.
Let's take a step back and talk about the sub-debt issuance process. Now, listeners can check out our past episode with Jeff Cardone for an attorney's perspective on the legal structures to the process. Now, I'd like to talk about the process once the capital has been issued. For instance, if a credit union was to issue $10 million, tell us about the flow of funds from issuance all the way to where the deposit is back on your balance sheet and then its life cycle over the next 10 years.
I can start off with that a little bit. So with the issuance, once a credit union makes that determination to actually issue the debt, that's where Alloya steps in. And we're actually working with Jeff Cardone and Luce Gorman and another partner to help build and simplify it for credit unions to actually get it issued. The simple process is they discuss it, they get through the application requirements with NCUA and their state regulators, get approval. At that point, Alloya and the legal team help step in to build offering documents, find investors. That's proving to be a little bit more of a difficult aspect of it. One thing to keep in mind with credit unions, now credit unions can do this on their own in theory. The regulation allows them to actually sell these notes. If they had someone, a friends and family type credit union down the road that was willing to purchase subordinated debt from them, they can actually do it themselves. But the regulation does require, if they don't do it themselves, that it goes through a registered broker-dealer. It's a little different than the secondary capital regulation that didn't have that type of requirement. Once that happens, that's where our broker-dealer steps in. Our Alloya Solutions investment representatives go out and start giving an offering document and any type of marketing materials to potential investors. Once we get indications of interest back in with us with amounts that investors want to purchase, potentially interest rate that they would be willing to accept, whether that's the initial fixed rate or if it's a fixed rate deal overall, what rate they'd be willing to accept. And at that point, we work with our issuer to say, this is the indications we have. Here's where we need to place this at what rate for everybody that we can get a full subscription to it. At that point, once that agreement is set and we have terms set, settlement process is relatively simple. We build a note, physical note, and purchase agreement. We get those pushed out to credit unions on the investment side to sign, as well as our issuer. As these start to build, one of the things that'll change with that, and one of the things with the larger deals that you'll start to see, is it'll act a little bit more like a standard private placement from the industry perspective, where they will be DTC eligible. So that's a global note consideration as opposed to physical notes. And that'll depend on the type of investor. We do not anticipate that we'll be putting these out to actually individual accredited investors, which is allowed within the regulation. We think they'll all be entity accredited investors or qualified institutional buyers. So that's where, depending on the size of these, you might just see some with physical notes and some that will go into with QSIPs into the global DTC note aspect of things. But once that's done, funds are transferred to Alloya. That's what we do. We are a payments company, a transaction organization. And so we handle those payments between buyers, investors, and the issuer. Money changes hands. At that point, it's complete, right? So the money comes in from those investors, either through us, potentially down the road with larger deals. Again, that could be handled through a separate settlement agent, depending on the type of investors. But issuer receives the funds, they drop on their balance sheet, counts towards their capital, they've got the cash, they can, at that point, do whatever they like with it. From there on, they'll start making their interest payments. Typically, you're going to see these are going to be quarterly or semi-annual interest payments. We've seen a little bit of both. It just depends on the issuer and what their preference is or what investors are looking for. Alloya can actually handle that as well as a paying agent, depending on the credit union and who the investors are for them, because we do hold their accounts at Alloya. So that makes that process fairly simple. At that point, then it's just servicing it, right? It's annually providing potentially annual reports to those investors, those types of things, making your interest payments until you get to year 5 through 10, when the rate may adjust. The other aspect of that we didn't talk about is the prepayment component of it. So these are potentially callable. NCUA, what they did with the regulation, and this is the same with the bank side of things, is the balances that you own. So say you did a $10 million issuance. After 5 years, in those last 5 years, it reduces by 20% per year how much counts towards your net worth ratio. So if you issued $10 million beginning in year 6, only $8 million counts, and then $6 million, 4, 2, and 0 as you get to year 10. And so NCUA does allow those issuers to prepay those amounts at that point in time with their pre-approval. You have to request approval each year to do that. But you'll see the structure of all of these in the notes and purchase agreement will have that potential prepayment callability available. And that's pretty much it. That's the process and the flow. Relatively simple once you can find investors and get them ready to go.
Absolutely perfect. That's exactly what I was looking for. Greg, did you have anything to add to that, Bill?
No, that was flawless.
It was. It was a work of art. Absolutely perfect to really understand how the entire process gets done. I'm going to give you 2 questions. So Jeff had said that he was seeing a lot of credit unions get pre-approved to be able to issue. Any comments you have about the pre-approval thoughts? And then the second is, if you haven't gone through pre-approval, how long is it from pre-approval all the way to issuance? Compared to if you've got the pre-approval, then what is your time to issuance? Or is there a further step down the ladder that you should take before you pause? Because you truly engage once you go to issue. So how far should you go in advance of that to be ready, to be nimble?
Sure. We'll take the first step. So in terms of the pre-approval, and I know Jeff is a fan of that, and I think most people are a fan of that. There's really 2 steps to this process, right? There's getting approved, and then there's issuing of the funds, right? And so the approval aspect of it, once you're approved, you get 2 years to go forward and issue funds, right? So that's the crux of the regulation. So the reason why you would want to get pre-approved is to remain nimble depending upon what interest rates happen, right? So as an issuer, flexibility is your key, right? So in a rising rate environment, you want to issue as quickly as humanly possible to save yourself on the interest expense, right? But I don't know, is it always going to be a rising rate environment? I mean, if you talk to certain people, say, hey, yeah, the Fed's going to raise rates 9 times in the next 2 years. Or maybe you think that the Fed is raising rates just to cut it in the next 6 months, right? I mean, they've proven to do that.
Is that what's going to happen, Bill? Is that an economic forecast? I need that. Let's hear it.
I am not an economist, although I would argue that economists are about as useful as weathermen. So I don't think anybody can read the future. And if we could, we certainly wouldn't be working with credit unions. So all that being said is if you go and get pre-approved, you can use the environment to your advantage, right? So that's kind of the process. And the process of being pre-approved can take anywhere from 1 to 3 months, depending upon how far along you are. And really what that is it's the building of the business plan and the application to go to the NCUA. It's coming up with the narrative around why you need the funds, but most importantly, how you're going to repay those funds. And it's the pro formas along with that, what you're going to do with the funds. And like I said, the most important thing is how you're going to pay those back. So some credit unions, have that kind of business plan already built. And it's really just getting it into an application and then getting it to the NCUA. There's some conversations you want to kind of get the NCUA, let them know that this is coming. But that could take a month if you're on top of it. Generally speaking, most credit unions are going to take 2 to 3 months to get approved. You have to get the board approval. There's some board acknowledgement that you have to get.
So let me stop you, Bill. That was going to be my next question. Is there some educational material that Alloya has created for a CEO to work with their board?
Sure. We have a microsite, alloyacorp.org/subordinated-debt. And anybody at any time can go out there and do that. One thing that I will say is every application and every issuance is unique. And therefore, if you are interested, come and talk to us. Go and talk to anybody. And we'll actually work with our partners to get your board educated on this whole process. That's part one. So while we do have some canned stuff, we have webinars out there. Greg and I think I've done 2 of them. You can go and listen to them at any given time. You can listen to you on the show podcast at any given time. A little shameless plug. Ultimately, we want to cater to you and your credit union. I know Greg has given a couple things to individually to credit unions. So that's what we want to do. Further, so that's 1 to 3 months, right? You got to get the board educated. You got to get the application good with the pro formas. You put it in for approval. From there, you generally wait 60 days or longer for the NCUA because the NCUA gives itself 60 days to come back with approval or denial or request for an extension, right? And one of the interesting things that we found out is they can just grant themselves additional time should they need, right? Which is really interesting. So I would tend to say 60 plus days right now is probably going to be the expected time frame for approval on that. And then once approved, you get the documents ready. Like Greg said, that can take a week or 2. And all in this time frame, we're sitting there talking with the credit union, discussing strategy on how to get the market, talking with investors. What are you seeing? What would be interesting to you? Things of that nature. We're trying to do that all on the back end, of course, without knowing whether or not this will be approved or not. But we're just trying to get some market color. Or once the documentation is ready, marketing material goes out to the investors. And so the one key to the closing process is that every purchase must be approved by the board of the investing credit union. And there's no way around that. So at a bare minimum, it's going to take a month to 6 weeks for every deal from the moment it hits the market to closing, which is different than the secondary capital.
All right, guys, this has been absolutely outstanding information. So summary statement, any final thoughts for our listeners, for the movement about what they need to be watching in the capital markets activity and the sub-debt market, and just any other final thoughts?
From the subordinated debt aspect of things, credit unions should just get educated on it and understand what it does for them. The one thing that we try to do with most of the credit unions we talk to is make sure they really understand the long-term nature of this product, right? If they move forward with this, they can't get out of it. It's not something that they can do this year and 2 years, say, oh, we don't want this anymore. We're just going to pay it off. It doesn't work that way.
Especially until you get that capital markets live, right? Yeah, it's a pretty significant commitment. Yeah.
Right. But even that, from the issuer's perspective, it's there for 10 years term. They can't get away from it. So it is a long-term decision that may span management teams and boards of directors. And so we just want to make sure the credit unions are very educated about that and don't move into something that really maybe isn't something they really need to do at this point. And that brings up that point where maybe getting pre-approval is not a bad thing. If you want to consider this, start down the path of getting the approval. You have 2 years before you actually have to issue. So if you get approved, you can wait. You can sit back and hold off and not issue and take a little bit more time. And so that's one thing that we have recommended credit unions consider doing, depending on their strategies, whether they're looking at mergers, acquisitions, bank acquisitions, things like that, for them to consider. But that's probably the biggest issue. Other than that, from the issuer's perspective, as long as you're knowledgeable about what's going on and you understand what the long-term ramifications are and the financial concerns might be from paying it back and your actual costs of issuance, it's definitely something that everybody should be aware of, how it could work for them, and potentially start incorporating those into their business plans today, that it's something they will consider maybe in the future, whether that's 6 months or 2 years from now. But we're happy to talk to any credit unions. We've talked to hundreds probably at this point.
Change is coming and change is good. We're changing. Credit unions are growing. Credit unions are evolving. That's not necessarily a bad thing. So we look forward to working with credit unions, all things capital markets related.
Well, thank you, guys. Thank you for your service to the credit union movement and for your great content on CU on the show. I look forward to when you tell me, hey, I've got this new thing that's happening that the movement needs to know about, and we'll get you back on again. Have a great rest of your day.
That sounds great.
Thanks,
Thanks, Doug.
Thanks, Doug.
Great talking to you.
Bye.
That's all the insider credit union knowledge we have for this episode. Are you enjoying the conversation? Be sure to subscribe and share your thoughts with other credit union leaders by leaving us a review. See you next time on CU on the Show.
The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Economic forecasts set forth may not develop as predicted. All performance referenced is historical and is no guarantee of future results. Indexes are unmanaged and cannot be invested into directly.